Are we heading toward a national bank? Hey, this is Michael D. Butler. I'm your host on the Michael D. TV show. And the late, great Supreme Court Justice Anton Scalia was often in dissent in key legal cases during his long career. Almost 30 years ago, he wrote that day by day, case by case, the Supreme Court is busy designing a constitution for a country I do not recognize. This quote comes to mind because it seems that this week, that crisis by crisis, the Federal Reserve, lawmakers, and regulators are busy designing a financial system that looks a great deal like a national bank. Now, I'm not saying that this is a hidden political conspiracy, nor do I believe there's some sort of puppet masters pulling the strings behind the scenes. I'm not wearing a tinfoil hat today, but listen, I'm asserting that the more the government tries to take risk out of the financial system, the more they are moving the country in the direction of a national bank, intentionally or unintentionally. Let's go on our time machine back to the 70s. Remember the great savings and loan debacle? After the absolutely awful monetary policy of the 70s and the Fed's fight against inflation that caused that savings and loan disaster? Do you remember how many banks failed across the country? One regulatory response to this mess was risk-based capital rules, which is what we've had for the last 40 years. Different loans or bonds had different capital requirements based on riskiness. Included with this was a much lower capital requirement on Treasury debt. This worked fine as long as interest rates were falling, but clearly doesn't make sense when the rates are rising. Banks had an incentive to hold more Treasury debt, which subsidized government borrowing and encourage more spending. Then came the bailout of the long-term capital management in the late 1990s, which showed that policymakers considered some financial firms, whether regulated or not, too big or too intertwined with other institutions to be allowed to fail without government intervention. Then the financial panic of '08 caused massive changes in our monetary and banking systems. These changes included a huge increase in the size of the Fed paying banks interest on reserves, extremely low short-term interest rates for an extraordinary period of time, and even more stringent regulations on the banks. A few people talk about the extent of these changes or even focus on them, but before the panic of '08, the Fed had total assets of about $870 billion. That's a billion with a B. As of Wednesday last week, its assets were around 8.6 trillion. That's trillion with a T. Now, the Fed increased its balance sheet by buying Treasury debt, which allowed government spending to soar. Now, the Fed also held interest rates artificially low for a long time, making that increased spending cost less. Meanwhile, the Fed started paying banks interest on reserves. At first, this policy didn't mean much. After all, banks were only earning 0.25% per year on the reserves. But now that banks are earning 4.65%, it's a much bigger deal. In fact, given the increase in short-term rates in the past 15 months, the Fed is now paying banks more in interest than it earns on its bonds. Banks own about $3 trillion in reserves on which the Fed pays interest. So if short-term rates increase 5%, banks could earn about $150 billion per year. And what do the banks have to do to earn that money? Nothing, literally nothing. Just sit around, keep the reserves on their books, and collect rent. Think how the public and lawmakers will react when that becomes more widely understood. And now think about the implications of the recent failures and rescues of Silicon Valley Bank, Signature, and First Republic. In spite of all the new banking regulations and a massive Fed balance sheet that supposedly protects the systems, banks are failing. Now, the government has stepped in and, in effect, guaranteed all FDIC-insured deposit accounts, no matter the size. Adding to the perverse incentives, the Fed is valuing government sector debt at par value for collateral, even when the debt is trading at a discount. The same treatment is not being extended to private debt, another special for public sector entities. And as depositors now know they're protected, they don't know, as depositors now know they're protected, they will seek the highest deposit rates no matter the riskiness of their bank. While the bank's managers generate outsized earnings until they go bust, at which time they'll get rescued if they play the political game of supporting the right causes. And if banks instead remain unsafe, deposits will flee to the very largest institutions deemed too big to fail. But that system, if you think about it, it's just not sustainable. If taxpayers are losing money, many of them will want the government to have more control, not less. And if capital is already being allocated for political reasons, there will be cause to just cut out the private sector middleman. Are regional banks and local banks going away? Something to ask. There is time to short circuit this process and change direction. But if there's one thing true about government, they never let a crisis go to waste. Unfortunately, with each new crisis, the window of opportunity to act grows narrower. This heading toward a national bank from First Trust, ftportfolios.com, and my client, my author, Robin Edgar. Thanks for sending and sharing. Lots to think about in this article. Are we headed toward a national bank? Drop your thoughts in the comments. Subscribe, hit that bell so you'll know when we go live, when we share a new video. Thank you for sharing and giving me your thoughts. This has been Michael D, Michael D TV. Hey, are we heading toward a national bank? God, I hope not, but it sure looks like we are.